We're going to take a few minutes now to talk about the owner's options in the case of a foreclosure scenario. If you are facing this scenario, your options break out into two different categories depending on your financial situation. There are two kinds of default: curable default or non-curable default. In a curable default situation, your financial hardship realistically can or will be resolved in the near future. Essentially, you have the ability to make your payments, you want to stay in the home, and you can resolve whatever crisis led to your default. Curing a default is also known as reinstatement. If you are in default and it's relatively early in the process, you are in the reinstatement period where you can reinstate the loan if you have the financial ability to do so. You have a number of options you can pursue if you are in a curable default position. We will review them in sequential order of most favorable to least favorable. Now, the first option is a repayment plan, and it's simply great if you've regained work. The repayment plan is essentially repaying any arrearages on the mortgage plus whatever fees that have added up to that point. If your default was due to a period in your life where you didn't have money for whatever reason and now you have money coming in, then a repayment plan is a great plan to get into. They usually last about 12 to 18 months, probably more on the 12-month side, and require approval from both the mortgagor and the insurance company. They will ask for a down payment of about a month's mortgage payment. Setting up the repayment plan can be agreed to verbally or written up. So it's actually very simple if you can just talk to them over the phone and agree that this is what you're going to do. It's a great option if you can raise the money. If you get your mortgage current, then you just write out the mortgage and nothing ever happens. No changes at all. You stay at the same rate or whatever it later resets to and was rescheduled to do. The second option is called the loan modification. This one changes your loan where the last one kept the loan you had in place. The lender will capitalize the arrearages that you have built up into the principal of the loan and create a new loan. You won't know in advance whether the interest rates will be higher or lower, as it depends on what the prime interest rate is at the time. Just like with the repayment plan, you'll be required to come up with a down payment. However, this arrangement has to be in writing because just like when you got your original loan, that's what had to happen. So you'll have to come up with the down payment, sign it, and pay any fees that they ask for at that point. Now, FHA, Fannie Mae, and Freddie Mac offer incentives for lenders to do these loan modifications. The third option is a forbearance. In a forbearance, the lender simply suspends or reduces your payment, and at some point in the future, you and the bank agree to reinstate your payments and for you to pay the arrearages in a lump sum on your loan. What they look for here is simply your ability to repay the loan. The fourth option gets a little bit more complex. It's called a partial or advance claim. What that means is a third party, say an investor or mortgage insurer, provides you with the cash to reinstate your loan. So it's actually a mix of the repayment plan and someone else making you a loan. You sign a note with this third party to repay the loan either right away or later on. This note dictates whatever happens, so make sure there's an attorney involved and you know the structure of the payments. It can be a great option. Let's say a family member can help you with money and you can sign a note for it. That's one way it works. The fifth option is for seniors over the age of 62. Lenders can offer a reverse equity mortgage. The most common one that's out there is a home equity commercial mortgage, and what the lender will do is make a monthly payment to you, the owners, to buy the equity in your house. You will be granted a life estate and cannot be forced out of the house during your lifetime. So it can be a great option if you're over 62 and there's equity in your property. How much equity is required is lender specific, but lenders usually require at least 15% equity. The last option for a curable default, should you consider it, is a refinance. It is a short-term fix and often doesn't solve a long-term problem. It does work for some scenarios, but if you can make one of the first 5 of the reinstatement options work, you should do so. But if they don't work, the last option is to refinance. Refinancing is difficult right now. A lot of people have cashed out the equity in their property and there's nothing left to refinance. It depends on having some equity, and with lenders getting more conservative, they are not going to lend you 100% of the value of the house. If you have a lot of equity and your credit is still good, it's an option, but it's an option for very few people. And a lot of people burn a lot of time trying to chase that down while they could be pursuing a more realistic option.